Hello and welcome to another edition of Market Briefing. I'm Martin Bakkerdax, European business editor here at the IB Times UK. Well, stocks are backing away from multi-year highs for the second day, but really it's about the bond markets and the economy rather than what we're seeing on equity indices. I say the economy because industrial production around the Eurozone details were just released for the month of January by Eurostat, and they are grim indeed. Industrial production falling 0.4% on the month and a little more than 1.2% on the year. That does suggest that the recession that the Eurozone is currently mired in will probably extend throughout the first quarter of this year. This, of course, just comes off the heels of data yesterday out of the United Kingdom, which suggests that Britain is going to have to work very hard indeed to avoid its own triple dip recession. As you can imagine, that has bond buyers very, very interested indeed, because bond prices do tend to rise as the economic fortunes tend to fall. Now, this may also put a little bit of pressure on the European Central Bank for its next interest rate meeting in April, and some analysts are already suggesting that the grim data will mean that the ECB drops its record low 0.75% base rate for its monetary financing operations, and that, of course, would be also bullish for the bond market. We'll have to see in the coming days. Also in the bond market today, Italy's going to try to raise about 9 billion euros in a four-part auction, which of course comes right in the teeth of its political gridlock and indeed increasing concerns over its economic fortunes. But on the plus side, Ireland is going to try to raise around 3 to 4 billion, actually maybe around 2 to 3 to be perfectly honest, in benchmark 10-year notes. It's the first benchmark bond sale by Ireland since it was rescued by the EU and the IMF in 2010, and it marks an amazing turnaround story for the Irish economy, which is likely to grow by about 1.3% this year. Unemployment is still relatively high, but investors do like what they see, and this could mark the slow step towards not only exiting the 85 billion euro bailout, but also getting comfort from the ECB's outright monetary transactions program, which would support bond yields. The latest data that we've seen on the screen suggests investors are bidding for as much as 10 billion euros of the 2 to 3 billion that are on offer. The yield for the benchmark 10-year notes will probably be in the region of 4.25%. So it does suggest decent investor appetite, but again, just represents another amazing turnaround story for the beleaguered Irish economy. That's it for now. We'll see you tomorrow.